Bitcoin has created billionaires, survived massive crashes, government restrictions, financial scandals, and years of predictions that it would disappear. Today, some investors call it digital gold. Others believe it could change the entire financial system, but one of the most successful investors in history still refuses to buy it: Warren Buffett. Buffett built Berkshire Hathaway into one of the world's largest companies. He has spent decades searching for valuable investments. Yet when it comes to Bitcoin, his answer has remained almost unchanged. No. But why? Is Buffett too old to understand new technology? Did he miss one of the greatest opportunities in history? Or does he see a risk that Bitcoin investors ignore? To understand Buffett's answer, we first need to understand how he thinks about money. Most people look at an investment and ask, how much could this be worth in the future? Buffett begins somewhere else. He asks, what does this asset produce? That single question explains almost everything about why he avoids Bitcoin. Imagine owning a small coffee shop. Every morning, customers walk through the door, they buy coffee, and the business earns money. If the shop is managed well, its profits may grow over time. The business produces something. It creates cash flow. You do not need someone else to pay more for the shop tomorrow, because the business itself creates value. Now, imagine owning a farm. The farm grows crops. The crops can be sold, and the farm may continue producing income year after year. According to Buffett's philosophy, productive assets have value because they can generate future cash. You do not need to find a new buyer immediately. The asset itself can keep working for you. Bitcoin works differently. It is not a company. It has no factories, no products, and no profits. Bitcoin does not pay dividends, and it does not generate cash flow. If you own 1 Bitcoin today, you will still own 1 Bitcoin tomorrow. The asset itself does not create income. Its price may rise, but that depends on what another buyer is willing to pay. When you buy a successful company, you own part of its future profits. When you buy a bond, you expect interest payments. But when you buy Bitcoin, you are mainly expecting demand to increase. You hope that someone in the future will value it more than you did. That is why Bitcoin does not fit naturally into Buffett's traditional investment framework. In 2022, Buffett made his position even clearer. He said that if he were offered all the Bitcoin in the world for just $25, he would not buy it. At first, that sounds impossible. Bitcoin is worth hundreds of billions of dollars. So why would Buffett reject it, even for almost nothing? His argument was not about Bitcoin's current market price. It was about what Bitcoin could actually do. If you owned every farm in America, those farms could produce food. If you owned apartment buildings, people could pay rent. If you owned major companies, those businesses could generate profits. But if you owned every Bitcoin, you would still need someone else to buy it from you. In Buffett's view, Bitcoin does not create value by itself. Its value depends on the market continuing to believe in it. But Bitcoin supporters argue that Buffett is asking the wrong question. They do not see Bitcoin as a company. They see it as money, or digital gold. And gold does not produce cash flow either. Gold does not pay dividends. It does not generate profits. Yet people have valued it for thousands of years. Why? Because it is scarce, difficult to create, widely recognized, and trusted as a store of value. Bitcoin supporters believe Bitcoin has similar properties. Its supply is limited. It can move across borders, and no single government controls it. From this perspective, Bitcoin does not need to produce cash. Its purpose is not to operate like a business. Its purpose may be to store value. The disagreement may not be about Bitcoin itself. It may be about what Bitcoin is supposed to be. Buffett sees an asset that produces nothing. Supporters see a new form of money. But Buffett would likely argue that scarcity alone does not create value. Imagine creating only 1 million collectible cards. They are rare. But if nobody wants them, their scarcity does not matter. For scarcity to create value, People must continue believing that an asset is useful, desirable, or valuable. Bitcoin depends heavily on this network of belief. The more people trust it, the more useful it may become. But if confidence disappears, its price can fall quickly. This brings us to another reason Buffett avoids it: volatility. Bitcoin has experienced enormous price increases, but it has also suffered dramatic crashes. For some investors, volatility creates opportunity. They see large price movements and imagine large returns. But Buffett is not searching for excitement. He is searching for predictability. When he buys a company, he wants to understand how it earns money, who its customers are, what its costs may be, and whether it can remain profitable. Bitcoin is difficult to evaluate using those tools. There is no income statement, no earnings forecast, and no traditional calculation that can tell Buffett what one Bitcoin should be worth. That uncertainty does not automatically mean Bitcoin will fail, but it means Buffett cannot evaluate it in the way he prefers. Buffett often talks about staying inside your circle of competence. This means understanding what you own. You do not need to understand every industry. You do not need to invest in every trend. And you do not need to buy something simply because everyone else is making money. Buffett built his fortune by ignoring many opportunities. He avoided businesses he could not evaluate, even when they were popular, even when prices were rising, and even when other investors believed he was missing out. Bitcoin may simply be outside the framework he trusts. That does not prove Bitcoin is a bad investment. During major Bitcoin rallies, the pressure to buy becomes intense. Social media fills with predictions. Prices seem to rise every day. People begin asking, what if I miss the next big move? This is called FOMO, the fear of missing out. But Buffett's career has been built on resisting that feeling. He does not believe every rising asset must be purchased. He does not believe popularity proves value. And he does not believe investors must participate in every financial trend. Sometimes, the most difficult decision is not choosing what to buy. It is choosing what to ignore. Bitcoin may rise, fall, or become an important part of the future financial system. But Buffett does not need to predict all of that. He only needs to decide whether it fits his strategy. For him, the answer has remained no. He prefers assets that produce something, businesses that earn profits, and investments whose value he can estimate. Bitcoin supporters may believe that scarcity, decentralization, and growing adoption create value. Buffett believes productive assets provide a stronger foundation. Both sides are looking at the same asset through completely different lenses. The lesson is not that Bitcoin is good or that Bitcoin is bad. The real lesson is that every investor needs a framework. Before investing, ask, what does this asset do? Why does it have value? What could cause that value to disappear? And do I understand the risks? Warren Buffett may have missed some of Bitcoin's largest gains, but his strategy was never designed to catch every opportunity. His strategy was designed to avoid investments he could not confidently evaluate. After decades of success, Buffett still believes that knowing what not to buy can be just as important as knowing what to buy. So, is Buffett wrong about Bitcoin? Or is Bitcoin simply an investment that does not fit the rules that made him successful?